Morning, everyone. This is Steve Gaterman, and I've got Dan Hickman here with me as well on our monthly webinar with the Board of Realtors. What you're seeing there on the screen is Dan's going to go through a little bit of a tutorial how to submit a question, because the last few webinars we've done, it was not clear. So Dan, why don't you go ahead and take it from here?
All right. Thanks, Steve. Good morning, everyone. On your screen, what you see is just a sample of a screenshot. That used to be my desktop. And on the right-hand side is what you should see on your screen as you're participating in this webinar. And you can click on the little arrow at the top to expand this little block, and it will expand over to the left. And then what that'll give you is you see over here to the left the screen that's being displayed. Okay, right here you'll see this area where you can then type in questions, and we want to encourage you to type in questions during the presentation or toward the end of the presentation, whichever, as we like to do the question and answer period at the end after we go through the PowerPoint. And what you do then is you'll type in your question and then click the little send button that you see down there, down here. I also enjoy using the little drawing thing. And then you'll see your question displayed, and we will answer the questions. So we'll send this set of instructions as well as the presentation today over to Annette Schmiel at the office, at the Board of Realtors office, and she'll forward it out to everyone who had registered today. So that should be beneficial. So again, let me kind of show you real quick, because I think my screen temporarily froze there. What you see on the right-hand side is this kind of toolbar column. If you can click on the little arrow at the top, it'll expand your selection, and it'll look more like this that you see here toward the bottom. If you can see me drawing there with the little highlighter. And then you input your question, and you click the send button, which you now see on this next screen. So you input your question there, and you click this send button here. And then you'll see your question appear, and then we will be able to read the question and answer it the best we can, and if necessary, follow up and get the answer sent back out to everyone. So again, Annette will be sending this information out after today's webinar. So with that, we will go ahead and jump over to the presentation.
Are we recording?
We are.
All right. So this all started, this idea, with the Lender Realtor Committee last year. Closings were getting delayed, sometimes not closing at all and canceled, and some of the reasons with regards to the loan process. So as a committee, we came up with several things that as agents you could look at, be aware of, ask questions for of your buyers, sellers, so that the idea would be is to keep your closing on track and on time. So a lot of this is awareness. Some of this we try to think of most of what happens that derails or delays a transaction. Didn't cover everything, but we got it pretty well figured out, and it's all on one piece of paper that Annette will send out to everyone that has registered. So we're going to kind of go through the slides and kind of pick certain number of these things and kind of go through them line by line. And again, these are things as agents to be aware of so that you're closing and you're approaching your contract and dealing with the sellers can stay on track. And there's actually some things in here to prompt you to do some work ahead of time. So let's get started. Starting with pre-qualification or pre-approval. That's always the best thing to do before a customer writes a contract. Those things, the qualification and or even approval, sometimes mean different things to different lenders as far as how deep they go in qualifying someone and if they pull credit. But you need to ask the question to see if your client is qualified, very minimum, and pre-approved potentially. The letter that they may get may look to be very have a lot of holes in it, if you will, and not be very sound. The lender would basically be able to determine what documents they've received. They pulled credit to be able to generate a letter. But those letters, as you know, as agents, can vary widely between lender and lender. But they need to talk to someone, have credit pulled, and also get a determination of what they can do as far as qualify. Questions to ask of buyers and the mortgage loan originator. Is a training course required? The OFA programs in many cases require that. Is the loan officer familiar with the loan program? For example, a 203K is a very complex program. Sometimes USDA can be the same. If a lender is not familiar with that program, it can mean delays or not closing. Is there a non-purchasing spouse? I think that gets forgotten about many times. If the other spouse is not purchasing the house, not going to be in the loan for whatever reason, that needs to be known up front with the lender so that we can advise them how to proceed, as well as they're going to have to be at closing to waive dower. Are they in the middle of getting a divorce? Just had one happen this past week. They are discussing a divorce, but they are not finalized. And if the person is right in the middle of a divorce, in many cases, the underwriter may, if they have children, they may want to know what that child support looks like, if there's going to be any at all. So that could delay the closing until some of this information is found out, if they are in the middle of a divorce. If they are legally separated, that's a little bit different. Or if they actually fully divorced, of course, that's different as well. But sometimes you may not know as agents if they are, but there's a checklist, as I said, we're going to give you, and it might be just part of the conversation you have with a potential seller or buyer. Ask all buyers to show me the money. Of all the things that's changed with lending in the last several years, the one that's changed most significantly and causes the most pain, and I think Dan would agree with this, is assets. And in particular, if there are deposits in this borrower's account, we have to document the source. And we're not talking about their paychecks. We're talking about other things going in there. We're required to document the source of funds. And in some cases, depending on the transaction, depending on the buyer, it may be a deposit of $100 or $150 or $300 that we have to have them document. Again, it's lender specific, but in general, you can advise your buyers that any money going into their account will have to be documented, sourced, and proven to the lender. And again, this is the one that seems to cause the most pain. So if you kind of cover that up front with your clients and through the checklist, they'll be aware of what's needed to document that.
Yeah, I agree, Steve. This is probably the biggest one, and there are a few others, as the things have tightened back up the last couple of years in particular. And folks, really, what this has gotten down to is when we as lenders look at the borrower's bank statements, every deposit on that bank statement that's not already identified on the statement, such as a payroll direct deposit or a Social Security or child support deposit, every other deposit that was just a regular teller deposit or an ATM deposit, we have to question every single one of them. They have to explain them, and almost all of them, any significant deposit value, $500 or more, say, we are also looking to get documentation of that, and that's because of the lending regulations, and it's also because now lenders are required by the government to look at activity in consumers' banking accounts when they apply for loans and provide bank statements, and even file what's called a suspicious activity report, or a SAR, S-A-R, with the appropriate agency if deposits look unusual for a person's income. And so we're not only doing lending, we're also policing money laundering and the Patriot Act at this point. So it just is what it is, and all of us as lenders have to deal with it, and it's best if our clients, your clients, and ours know about it up front.
Yeah, and one thing I'll add is not just deposits, but the activity on especially a checking statement. If someone is using a check card or they're doing bill pay, if they're using that account and they're paying a bill and the bill doesn't show up on the credit report, in many cases the underwriter is going to question that. Is there a bill? Is there a debt out there that we are not aware of? So in addition to deposits, the bill pay section of that checking statement will be reviewed as well to make sure there's not additional debts that were not listed on the credit report.
Great point.
Okay, buyers, kind of do's and don'ts. After you start your application, don't change jobs. Don't move money around. Don't apply for new credit. Hold off purchases, especially for things they want to buy, furniture, appliances for the new house or a new car. Once someone gets approved, they think that they're good to go, In many cases they are, and then they start changing their situation. And I know Dan has run into situations where someone's changed a job, they bought a car, they open up a new account to buy furniture, and sometimes it caused the transaction to be declined at that point, and then they could not buy the house. So a good lender is going to advise them of not making changes when they're in the loan application phase.
Absolutely. And we could tell lots and lots of stories here, but we won't in the interest of time. So
the property condition may dictate the loan product, of course. Does it need repairs, rehab? Is the seller prepared to make the repairs? Is it necessary for a rehab loan, such as a 203K? Is it a condo? Condo has its own special list of guidelines. For example, in most cases with most lenders, the condo project needs to have some kind of a review. If it's FHA, it'd be on the list. If it's a conventional, be on a list of lenders or looking at that a little more closely. Is it rural? Meaning that is there acreage involved? Because after so many acres, depending on the program, the loan may not be eligible for that financing. And if it's rural, does it have a cistern? In many cases, a cistern is not an acceptable source of water, especially for FHA without prior approval by the local FHA office, regional office. The rehab is more of an issue recently with people buying bank-owned properties. So when someone goes into one of those homes, it needs to be pretty clear up front if they're going into repairs, they should probably get pre-qualified with, for example, a 203K or a renovation loan to make sure that they qualify for that financing before they go into a house that needs repairs. The Home Path program, which I think we will talk about in the future, that is an as-is property. So whatever the property value comes out at, or based on the appraised value, or based on the contract, I should say, they take it as is unless it's noted as needing some repairs. So this is pretty important, and the buyers don't understand. If you've got questions, if you think it's on the fence of maybe needing repairs, you may want to contact your lender to find out if it may pass based on needing some repairs. So we're not talking about cosmetics, but structural things, bad roofs, for example, obvious holes in the walls, and some needed maintenance. Additional considerations. Is the property ready for appraisal and inspection? Will utilities be on? That happens quite a bit with bank-owned properties. Many times we have to send the appraiser back out because the utilities were not on, and they have to be on when they do their appraisal, which adds delays and costs for everyone involved. Are there good comps available for the appraisal? A lot of realtors will have a set of comps available for the appraiser when they come to the property or send them to them. Good idea. As we said earlier, septic, cistern, well inspections, they may be needed on many of those programs. So additional requirements on some of those rural properties especially. Is it in a flood zone? You generally won't know if it's in a flood zone. Most lenders will automatically do a flood certification to verify it is not in a flood zone. If you have a suspicion, though, you may want to flag that to advise the buyer, because if it is in a flood zone, they'll have to get flood insurance, which will add to the cost and maybe change their qualification. Property taxes. Again, because of all the bank-owned properties and foreclosures, the property taxes don't appear to be correct on many of these properties, especially if they're bank-owned. As a lender, we need to use or have to use what's on the tax bill, the most recent tax bill, for the qualifying purposes. But definitely check that the Hamilton County Water's Opsite, for example, or the Butler Warren County as far as the correct property taxes, because that is important. And we will look at that and validate that to make sure that that's part of the payment and they qualify. Homeowners insurance policy. This always comes down to the last minute, Dan, for some reason, and it's changed with the insurance companies. They need more time to generate a policy. They do some sort of a pull for a credit. They, in many cases, want to look at the property, at least a drive-by, take pictures. So we don't seem to get these that quickly as we used to. So the best advice is after they have their house selected and gone through inspection process, have them start doing some research on the insurance, because sometimes they want to shop around for that and call more than one insurance company. But don't wait for the last minute on that. That can be problematic.
Yeah, you're right. It's surprising how often it does come up toward the end. And, this and, the do's and don'ts for the buyer. A lot of lenders will have a discussion with their applicant up front during the pre-approval process, or at least at the application part of the process. And a lot of lenders will have a form letter or a document that they provide. I know I have one that I've used for a long time that I call the "Don't Do Anything Stupid" letter, and I provide it to the client, and we review it, and we talk about some of the do's and don'ts that we showed here a few minutes ago, and also emphasizing their need to go ahead and identify who their insurance agent is now and get that set up. And Steve, you're right. They need more lead time nowadays. The insurance companies, they're supposed to go to the property physically and some other things. So great advice here, additional considerations for our buyers. We have a couple of questions that have popped up, and we're going to come back to the Q&A once we get through this. I think that's probably easier for the flow.
Sure. Is the relationship between parties involved? Relationship among the parties can affect the loan terms. Talk with your originator. For example, if they work for a business that's family owned, that's not a problem in itself, other than most loans require 2 years of tax returns if they work for a family member. Is there anything else that comes to mind as far as this topic here, Dan?
Yeah, if the buyers and sellers are related.
Oh, that's true.
Yeah.
Buyer sellers related. If they're buying a home, like if it's a builder from the builder, there's some other considerations there too. So the one that's most common is if they're buying from the seller and they're related to them, or also if they are working for a relative.
Yep, absolutely agree.
Contract, dates and timing, very important. Loan commitment and closing date, reasonable. Again, it depends on the loan product, how much time you need. Wherever that buyer got pre-qualified, I'd ask the lender what their turn times are so that you're writing some dates in the contract that are attainable. Generally speaking, if it's a bond loan, Ohio OFA loan, if it's sometimes a rural housing loan, those may take longer to close. There's extra steps lenders go through as part of, you're seeing in part of this presentation, but generally speaking, we can get a loan closed in 30 days. Sometimes it takes longer, and to be quite honest, a lot of that time is taken with the document collection from the borrower, from your client, and then the inspections also can delay this too. So in a perfect world, 30 days is usually ample time, but that is providing the borrower has other documents to us right away within a couple of days of the contract, and the inspections don't delay it as well. My suggestion typically is for a little bit longer time, close early to get it done. If the buyer's already pre-approved, that's going to save time too. You won't have to write as much time in your contract and have less delays as well. But definitely ask the lender what their turn times are as far as the program that they're applying for. Commitment time too. This doesn't come up too much, but it is in the contract, of course, and the loan commitment is generally the loan being fully approved as well as the appraisal being done. And with today's environment, we get a loan approved, but there are conditions of that approval. For example, verifying the person's still working. Maybe we have to pull credit again or get an update on credit. So depending on what the seller wants, if they want a commitment without any conditions, that's usually done right before closing. But the initial loan commitment, which is how most contracts are written, the initial approval post-appraisal, that can be gotten in a relatively short period of time. Buyers and sellers understand the deadlines. A lot of times they'll drag their feet with regards to, like we said, getting insurance. If it's a renovation loan, getting their contractors to give them bids. And again, as we said, inspections. Those can delay it as well. In many cases, we don't want to order the appraisal until the inspections are done. It really depends on the timing of the contract. And if we have to keep moving forward because of those dates, we may have to order the appraisal and hope the inspections work out. Again, it's a conversation to have with the buyer, your client, to make sure they have enough time to get all that done.
And the pre-approval at the beginning is key to this, and as Steve said, shortening the time frame, shortening the dates. And, talking with the lender is, the communication between lender and agent is one of the key things here. We're very limited, of course, as to how much detail we can get into as far as borrowers' information. But, some borrowers, if there's some work to do, especially if they did not start with a pre-approval or a pre-qualification, they write a contract for a home and then they apply for their loan, and they need to do it quickly within a day or two of that contract, as Steve mentioned. If they do that and they haven't already been qualified or pre-approved, and now we learn that there's some other cleanup that needs to be done, if you will, it can take a little longer. And the communication there is the key, though, between the lender and the borrower and the agent all being on the same page.
Impacts on financing buyers financing. Title company selection. Lenders' estimates for closing costs may not be accurate. Well, why is that? We have to, as lenders now, when we issue a good faith estimate, give all the costs that we're aware of, and we have to anticipate certain things and give costs on the high side. Owner's title, for example, we typically have to quote an owner's title policy in our estimate, which some buyers don't take. Many buyers do not take. So we're giving a quote for cost, and we are held accountable to that cost, and we cannot increase that cost unless there's been a significant change in the loan or loan terms. So sometimes you have a bank-owned property, and they're dictating what the title is. So we've quoted some title costs, not knowing what the bank's title insurance company is going to have, and so we are held to those. So it's kind of been an issue to some degree. That's why most lenders are quoting costs on the high side. They usually come in less in most cases, but as I said, because lenders are held to that initial good faith estimate of cost, that's one of the new regulations, they initially look higher than they typically will end up being, and that's a conversation you have with the buyer to explain to them, we're trying to quote everything on the high side. But it can be an issue because we don't have control of the title company. It's in our contracts that you have with the board now, and we are to basically honor that in most cases. So it puts us in a position. So we typically will estimate on the high side of cost. Won't you as well, Dan? Would you recommend?
Typically, yes. Yes. And you know, another interesting thing here, as Steve mentioned, you know, with the good faith changes that came out 3 years ago, 2010, you know, lenders are required to give this good faith estimate and be held to certain restrictions as far as how accurate those estimates are. Good intentions there for us as lenders, providing accurate numbers to a borrower up front, without a doubt. When we learn of something being different, however, there are limitations too on when we can actually redisclose to a client officially versus having that conversation. So it's something to keep in mind as far as the title company selection and working with your lender. The owner's and the lender's title insurance, you know, that needs to be explained and discussed. In some markets, now here in Greater Cincinnati, it seems that owner's policies are rarely purchased. In other markets, central and northern Ohio, for example, it's customary there for an owner's policy to be provided by the seller, and then the lender's policy premium that the buyer is responsible for paying is significantly less in cost. But here in our market, it just seems that owner's policies are still not that common, although they're a good idea for every borrower to consider. And are we really having that conversation with folks up front like we should be? I'm not sure if we are as agents and lenders. You know, the lender's policy offers no protection really for the consumer, protects the lender, and because it protects the lender and the loan balance declines over time, and it's only for the loan balance, it's less expensive than an owner's policy. An owner's policy protects the owner forever and for the full original purchase price, not just the loan amount. So if we're having those discussions with customers up front and helping them be better informed, I think that's a good thing.
Absolutely. The property disclosure, a good lender will look at that right up front when they receive that for issues that might come during the transaction, looking at how long they've owned the property. That's one of the considerations. Also, potential issues with the appraisal that they might see. You know, if there was a septic tank when the septic inspection. So, a good lender's going to review that and kind of point out any potential issues or extra steps we have to take because of that property disclosure.
Yeah, the lenders are requiring to see these disclosures. So, if there's anything on there that might indicate an inspection or whatnot, you know, taking a look at that up front closely can give us all a head start.
Impact on financing and timing. Sale of personal property included in the contract. Boy, is this a hot item or what? Generally speaking, any personal property, most lenders require to be removed. Now, it's not across the board, I'll tell you. It depends on the lender. But most lenders that are doing the FHA and VA and conforming loans that are sold through Fannie and Freddie, they're requiring that to be taken out. Even though your board contract says that these items listed on this line did not add any value. I understand that completely. Understand on the back end, when this loan gets sold or bought or reviewed by one of the agencies, they're kicking it out. They're not accepting the loan because it has personal property, even though your contract specifically says these items have no value. I know it doesn't make sense. I know that it's an irritation in many cases, but generally speaking, if it's in there, a lender is going to typically ask to be removed. What some lenders do, what some agents do is if they're going to have something of value, true value, that they actually do a bill of sale as part of the contract and buy those things at closing for $1, for example, a swing set or something. That's something you may want to talk to your lender about, but there are some ways to really facilitate that as part of your contract.
Yeah, this does cause a problem, and it's, as Steve said, it's in the agency guidelines, the Fannie and Freddie guidelines. It's in HUD's guidelines for FHA loans. VA and USDA generally look back to FHA for guidance on this. So all of your typical traditional secondary market loans, which are the vast majority of loans that are done, they all have restrictions against this. It's another one of these things that for a long time wasn't really enforced fully, but now that we're back to crossing every T and dotting every I, as Steve mentioned, the agencies are kicking these loans back that have these scenarios. And just to give you a quick example specifically, if there's a purchase contract and it says it's including a pool table, and the pool table, then we have to estimate, identify a value for that pool table. And let's say the pool table is valued at $2,000. That $2,000 is subtracted from the purchase price or the appraisal value if it happens to be less, and then the loan to value recalculated. And that then means that your buyer either needs more money down or they're looking at a different loan to value, which can affect their PMI or even their interest rate. And that is how it is to be done, and the vast majority of lenders do it that way because that's what's appropriate, although it can be frustrating, as Steve said.
Okay. Seller pay closing costs and or prepaids. The contract and the board has a provision for that to fill that out. That's important. There are some limitations on how much a seller can pay depending on the loan product. FHA is still at 6%. VAB is still 4%, and conventional can be, well, starting at 3% for 5% down and going upwards of, I think 9% actually, with a large down payment. Investment properties, you're not supposed to do that for a standard Fannie Mae Freddie Mac loan. So bottom line is it's allowed in most cases, but there are limitations. Check with your lender. Short sale, yeah, short sales, a lot of them happening out there, can be frustrating. Make sure that you have the appropriate contract for the short sale negotiated. That's a whole other topic that I won't spend a lot of time on right now. Relocation company involved. This can add some time. This can add some frustration for the agents that have dealt with relo companies. But again, it's some things to address and make sure that everyone's aware of. Okay, how being...
I'm sorry, homeowner warranty.
Homeowner warranty. Okay, how? Like, I'm not getting that. Is a homeowner's warranty being provided by the seller in the contract? Occupancy in 60 days. This comes up a fair amount. Maybe they want to do some work on the house. Maybe they want to get the whole house painted. That's great. It is in the documents they sign at closing that they will occupy the house within 60 days of closing on most of the standard loans that lenders do. If they don't, will they be watching them? Well, I'm not sure if they will, but that's the rule. And if they don't occupy it, they could call the loan due, technically, if it was ever found out. But that is the standard occupancy in most contracts that we'll need to see. If it's beyond that, then it raises some questions. We have to address that with underwriting. FHA VA mandatory clause and the LBP notice. The LBP notice?
Yes, the lead-based paint.
Lead-based paint notice. Okay.
I'm sorry, I was conserving space on this.
Okay, because I'm like, I'm not sure I call it that. But anyway, yes, do we have those in the contract? Are they negotiated? If you haven't, some boards have those in there, but lenders are going to require those amended to a clause and documents to be signed after closing, after application, I should say.
And these are all to protect, intended to protect the consumer, the buyer. More paper, more signatures, but good intentions.
Title considerations. Well, how long has the seller owned the property? This has an effect on the flipping rule with the variety of different loan programs, and depending on how long it has been, and if the previous owner was a bank or an individual, it has an effect. Again, it's something that as a good lender, when they get a contract, we need to know about that. And as a good realtor, if the property has just been resold and it's less than 90 days and it's not a bank, there's some considerations there that you need to be aware of and ask your lender as far as how that might affect the buyer. Multiple property transfers in the past year, again, that's looked at too when the title report is reviewed by the underwriter as far as questions, and it will have to be addressed. All sellers in the contract match owners and title. Needs to. Is there a private or shared driveway agreement? This happens occasionally, and sometimes there is not an agreement, and there's the parties that have been on this street never had one and don't want to sign one now, so it can be an issue in closing towards the end if you don't get the cooperation with all the parties on the street, if there's not one already in existence. So it's a good idea to address that up front when you write that offer, because the lender is going to require that in most cases. Again, all the agency, FHA, require a shared driveway maintenance agreement. Okay, some more. Are all the owners in title on the contract? Well, that's a good question. Needs to be addressed. Are there any special assessments? Again, sometimes those can be rolled over in most cases, but that needs to be addressed in the title. That's a question the underwriter is going to re-raise. Will have to be paid at closing, or will can they be rolled over into the future? Is the property registered land? That has some extra considerations and sometimes delays with recording. Is the property in a planned unit development? Is there a homeowners association? Again, we count the HOA fee as part of their payment, whether it's a condo or a single-family community that has a fee. We need to be aware of that because that's part of the ratio qualification on a buyer. What did we forget? Well, gosh, probably a lot, but we try to cover most of it. We're going to now kind of pop up the questions we have and try to answer some of those, if you will. And feel free to go ahead and type some additional questions in as we're addressing the first few, if you will.
Okay, the first question is, what do you mean by not moving money around? When the borrower, that's a good question. When the borrowers meet with their lenders at the beginning of this process, whether it's to be pre-approved or they've already written a contract, one of the half a dozen things that we ask them to bring, of course, are their most recent month or two of bank account statements, checking, savings, CDs, wherever the funds are going to come from for the transaction, which also, remember, doesn't necessarily mean just the down payment, but also closing costs or prepaids that they're personally going to have to pay if the seller is not, and also funds that we as lenders might be counting as reserves. Reserves are very helpful, particularly these days with a little bit more stringent lending guidelines than what we had there for a run of about a decade. And when they bring those statements in and we use that documentation to document that they have those funds, then if they go and they move money around and for one reason or another we have to obtain a more recent statement or a direct verification from their bank and the balances are suddenly different, then that's potentially an additional delay, getting additional documentation from the client. Where did that money go, or where did new money all of a sudden come from? Again, back to that documentation of all the funds. So it's best if once they've come in and met with their lender that they don't move money around from one account to another, and that we can document new monies. This time of year, we have tax refunds coming into bank accounts. We have those conversations up front. We know where they're going to be coming from. We have the proper documentation. This is another one of these things that can cause delays if we don't have the documentation properly and the discussions properly up front.
Exactly. So it's not a problem. It just can be painful, and it can delay things and frustrate the buyer. But in most cases, you can document it.
Here's another good question. What is a reasonable amount of time for loan commitment? You know, Steve, when he talked about this, he talked about when lenders get the initial approval out of underwriting, that can generally be done pretty quickly. And by pretty quickly, depending on the lender and the borrower's situation and the loan program they're applying for, you know, that can be a matter of just a few days to maybe a couple of weeks or longer. But you know, generally speaking, you can probably get a conditional loan approval pretty early on, within a week to 2 to maybe 3, depending on those circumstances. And again, communication with the lender early on in the process can give you a better feel of this on a case-by-case basis. The actual loan commitment with few, if any, conditions, like Steve said earlier, a lot of times that's, you know, toward the end, pretty close to the actual closing because of the appraisal and potential issues there and so forth. But, you know, a commitment with a reasonable amount of conditions, I'm going to suggest that your lender ought to be able to get for your client in most cases within a week or 2 of the application process, assuming there aren't any problems and that the borrower has cooperated with bringing everything that has been requested up front. Honestly, as Steve mentioned earlier, that's oftentimes the biggest cause of delay, the borrower not providing things in a timely manner. And hopefully the lender is sitting down and making that clear with the customer up front, here's what we need, and then if they're running into some delays with that borrower providing it, hopefully the lender is getting you involved. And you know, our hands are tied with getting very specific on what we need or why we need it perhaps, but if nothing else, if we let you know we're still waiting on some documentation from your client, we know that more than likely you're going to help us push them along.
Yeah, it's a very good question. And one thing, too, that's not going to be apparent is when you get that loan commitment, it can have, well, it can have 20 or 30 conditions on there, or it can have 5. And so if a lender submits a loan application to the underwriter and they don't have a lot of documents, they will condition in most cases for a lot of that information. Like they can condition for bank statements and pay stubs and W-2s. Well, if you have a loan approval, a loan conditional commitment in a week, and it has 25 conditions, of which one of those comes in and it's different from what the borrower told us, can take your approved loan to denial, I don't think that's a good loan commitment. So a good lender is going to want to get most of the information up front, and I say most of the information, their assets and their income. So those are the 2 big things that to have the underwriter look at. So when you get a loan commitment, you know that it's a pretty solid approval versus one that it's approved with a lot of conditions that might change that approval.
And this is another thing that goes back to that pre-approval. It's just such a benefit to everyone involved if the borrower gets a true loan pre-approval with his lender or her lender at the beginning of this process. So the next question is, when approximately does the appraisal occur?
Well, it occurs when the lender orders it. Again, that's part of the conversation the buyer has with the lender. If there's whole house inspections in the contract, which frequently there are, a lender should have a conversation with the buyer or the agent and find out when those are going to be. And in most cases, we will want to wait to hold off on ordering that appraisal till those are done, but sometimes we don't. The advice of the buyer or the realtor, or sometimes we can't because of the timing. So the appraisal can be ordered right after we take the application and have the contract. It's, as far as when you order it, really you want to time that with the home inspection. So, but it can be ordered relatively quickly right after the application is taken.
Yeah, one of the things there that does limit us a little bit as a lender are the RESPA and truth in lending requirements. When Steve or I or whoever the lender is meet with their customer in person and they get all the disclosures signed, they can collect the money right then and there and they can order an appraisal, unless the borrower wants us to wait until after the inspections if they have any concern, like Steve mentioned. When we're dealing with customers, or any lender is dealing with customers over the telephone or online, they cannot collect money from a consumer until after the consumer has acknowledged their receipt of the good faith estimate and of their, quote, intent to proceed, end quote, with that loan under RESPA. They also cannot collect, the lender cannot collect, until the consumer has been provided with a copy of the truth in lending statement. Both of which, by the way, the good faith estimate and truth in lending statement are going to change next year. That'll be a future webinar. But so these are a couple of little things that can create some delays. And the biggest one, like we've said a few times now, if they do want us to wait for an inspection, we can certainly do that. But everybody needs to be on the same page and understand then if we're waiting for 5 or 6 days or whatever for the inspection to be done and then for the buyer and seller to come to an agreement after that and then ordering an appraisal, well, that was 5 or 6 days that we lost. And appraisers are probably, today it obviously varies, but overall in our market here in Cincinnati, I'd suggest that to expect an appraisal in about a week from the time the lender orders it is probably reasonable. So the next question here is, you didn't say much about how a home warranty provided by the seller affects the closing. I don't know that it does, other than just making sure that the cost is handled correctly on the HUD one.
Right. If the buyer's paying for it, then we make sure that they have enough assets to pay for that as well. But other than that, it doesn't delay things on our side. Yeah,
that's a great question. I know we had it as a bullet point on one of the slides, and it's almost always paid for by the seller.
Right.
When should buyers apply for a homeowner's policy? Good question. I personally think they should do it right after they've written that contract. They have an accepted contract. Most buyers will contact whoever they have their auto insurance through, or if they're an existing homeowner, they'll contact whoever they already have their insurance through, let their agent know that they've bought a new home, give them the information, and they should have that information together then within a few days to a week of contacting their agent. They should certainly not wait until, okay, I'm closing in 3 days, I better get my insurance.
Right, not a good idea. It'll delay the closing.
So they should start that process early on and not wait till the last week. Here's a good question. On a recent conventional loan transaction, the appraiser's report triggered a roof inspection. Oops, I'm sorry. It triggered the lender to request a slate roof to be inspected and the remaining lifetime stated, and also required that mildew in the basement be mitigated. Are these government guidelines, or was this a particular lender's guidelines?
Well, I'll start on that, and Dan can jump in here. It's going to be pretty much across the board, FHA, conventional, VA, rural housing. The property requirements are pretty standard, and if there's mold in the house, that presents a problem for a lender on a traditional loan, not a 203K, for example, but a traditional does. And roofs need to have, in most cases, I believe it's 3, sometimes 5 remaining years of economic life. So if probably what happened there is the appraiser saw something wrong with the roof. The appraiser is required, because he's not a roof inspector or a professional in that area, to call for an inspection because he or she saw something, and the inspection was done and ordered, and in that inspection, the lender's going to make sure there's at least 3 years, usually in most cases, remaining economic life on property, on the roof, I should say. So that's how it triggered, and that can be triggered, and those can be required just on conventional loans as well as FHA and VA. And as far as the mold, if the appraiser sees mold, in most cases, they're required to mention it. Most lenders don't want to finance a house with mold because of all the obvious reasons, unless it's a special situation with the rehab loan. So they're going to have that addressed and mitigated typically. If it's missed, then it's missed, but if it's mentioned, the lender's going to be required to mention it and probably get it mitigated. What do you think, Dan?
I agree completely, and just a couple quick things I'd add. Just a reminder that this is really to protect the consumer, that the home that they're buying, once they get into that loan, into that home, they're not all of a sudden going to have a significant expense or a health risk. So, the safety and the soundness of that home is to protect, of course, the lender, because the home is the collateral for the loan, but also, more importantly, to protect that borrower and their family that's moving into that home. And if during the listing of the property or as a buyer's agent looking at a property, if there's any question at all, it would be a good idea to go ahead and get an inspection done up front by a roofer or by somebody specific to whatever the concern is. when the appraiser, as Steve mentioned, identifies that issue, he or she is basically saying, this needs a roofer, or this needs somebody specific to the issue at hand to do an inspection and tell us that it's okay. And that's the best way to go. A lot of buyers get whole house inspections, but if they then want to provide that whole house inspection to their lender to address just one specific concern, that can open up a whole nother can of worms. As a lender, if you're going to provide us with the whole house inspection to show us that the roof is okay, we're then required to look at that whole inspection. We're going to look through that whole thing, again, to protect that homeowner and also to protect the lender because the house is the collateral for the loan. But you don't want to provide a whole house inspection just to show that the roof is okay, I guess is what I'm saying.
Yeah, I would agree.
And to Steve's point, this should be across the board with all lenders. The next question, is there a way to expedite the processing of IRS transcripts required by the lender? Boy, that's a great question. And all too often, every now and then, basically, if it comes up at the last minute and it was a problem, either A, the lender made a mistake, which happens, and then they're scrambling to correct their mistake as quickly as possible, the mistake being they didn't order it soon enough. Or B, sometimes there are problems getting transcripts from the IRS because there are some systematic problems with the IRS. And the lender should be requesting those transcripts from their third-party service that orders them directly from the IRS for them. They should be doing that early on in the process. Things that can delay it are the borrower did not sign and return their documents quickly enough to their lender, because we obviously have to have a signed IRS 4506T to request the transcripts. And then sometimes there can be a delay with getting those transcripts back from the IRS. Here we are now, almost April 15th, and here shortly lenders are going to start requiring borrowers' transcripts for the 2012 tax returns. Currently, lenders should not be requiring transcripts for 2012 unless you have a borrower who is self-employed or for some other reason that lender needs to use their 2012 tax returns to calculate their income. If a lender needs the 2012 income from tax returns to calculate income for your borrower right now, then that lender would also need transcripts to validate the accuracy of those returns. Lenders are using tax returns to calculate income. They're using transcripts from the IRS to validate that the tax returns they've been given are accurate.
Yeah, and part of the delays you're hearing about running into is the IRS is fairly particular when they get this form that it matches exactly how the borrower filled it out. And this is what causes delay. They change addresses. They don't remember when they changed it or when they filed what the address was. They used the middle initial then, but they're not now. So what we do, what the suggestion I have is you get a copy of their tax return, maybe just the first page so you can see how they filled it out as far as the name and the address, and you match that exactly. The IRS is very particular, and they send these back all the time if it doesn't match exactly. They've sent them back because a person put on their tax return a period after their middle initial, and when they filled it out, it didn't have the period, and they sent it back to us. So these are the delays of the 4506. Dan was right in saying you get this done up front because there's a good chance it will come back by the IRS and have to be adjusted and signed again. So it's something you do up front to stay ahead of the game on this. It can cause delays, but usually it doesn't if you're looking at the tax returns, how they filed, the name and the address, and you kind of mitigate that issue.
That's an excellent point. And we've been telling folks now for a couple of years, ever since we've had to get transcripts on every borrower, not just borrowers where we as lenders have to have tax returns. We've been telling folks, originators, lenders, go ahead and get that most recent tax return. Get that tax return and look at it, even if you don't need it to calculate the income. We have to have it as lenders if you have a self-employed borrower or a significant portion of their income is commissions, or if they work for family business, or if they have rental properties, or if they have other sources of income that are only really documented on their tax returns, dividends and interest and investments and things like that. In those cases, we absolutely have to have tax returns. On other customers where we're just using more traditional income, W-2 employees and such, we don't really need tax returns to calculate income. But to Steve's point, we have to look at that tax return to make sure that we have the name and the address exactly as it appeared on their most recent tax returns and the year prior before we request those transcripts. Excellent point. So one of the key things as an agent you can do when you're telling your customer, make sure you get these items together for your lender, you know, your most recent couple of paycheck stubs and your most recent couple of bank statements on all your bank accounts, your most recent couple of tax returns, your federal only, we don't need state and local, but your most recent tax returns as well, so that the lender's looking at that as well. Great point. Great question. Next question is how long to get a 203K approval? The biggest challenge on that is on the front end with getting the bids, and there are a handful of forms. There's some documentation that the lender requires from the contractor, and again, getting that process started early on is the key. Once the lender has everything they need from the borrower and the contractor, and we provide information to the appraiser, of course, as far as what work is being done, so the appraiser can tell us the before and after value of that property. From that point forward, it doesn't take any longer than any other FHA loan.
Right. It's the bids and it's contract validation. It's the extra steps that delays it. And the biggest thing is the bids. Those will delay the process if the buyer does not jump on those. And sometimes they get them. They don't like the bid. They go back to a second contractor. So the key on the 203K timing is having the buyer proactive on the bids. In some cases, if there's a consultant involved, you get the consultant with the buyer go through the house, and they can pretty much tell you what the bids are going to come in at. They won't provide those for them, but they'll give them an idea so they know what they're shooting for, for what kind of work to get done.
And the key there, too, is the agent and the loan officer and the borrower all working together on the front end to make sure that those things are put together in a timely manner. So, you know, that's an additional week to maybe 2 on the front end, and then the process itself, the normal process. So if I were writing a contract as an agent, and I'm not an agent, I don't even play one on television, but if I was, I would probably write that for maybe a 60-day or no less than a 45-day. But the key to everything is cooperation on the front end and people doing what they've been asked of, the contractor, the borrower, and if the agent and the loan officer are working together to kind of, you know, keep them focused, it's not a terribly lengthy process. So that was a great question. And that is such a terrific program. I know we've done webinars specifically on that program. Next question is, can the buyer or borrower waive their privacy rights so the lender can speak freely with the realtor? I would say that most lenders are not going to be real comfortable with that, but I will tell you, too, that if the realtor and the borrower and the loan officer are together in the same room at the time of application or in an after-application meeting, and the borrower says, yes, I don't care if Bill or whoever hears my information, they'll have a conversation. We have to be very, very careful due to privacy rights what information we disclose to anybody other than the borrower. And that not only means the borrower's agent or obviously the listing agent that's wanting to know what's going on in the transaction. That also means, believe it or not, a non-borrowing spouse, okay, or a boyfriend or a girlfriend or a fiance or whatever. We have to be very careful, and I know it's frustrating. Believe me, it's frustrating for the lender as well because, you know, we want everybody involved to be informed and be able to help us push a borrower along to get us that pay stub we're still waiting on or that letter of explanation we're still waiting on or whatever it is, but we have to be very careful. But I would say, and Steve jump in here, but I would say any lender is really going to be careful in what they'll say.
Yep, I would agree.
The next, we live in a very litigious society. The next question, what happens when a home doesn't appraise for the purchase price? You know, great question. Lenders are very limited, originators in particular, are very limited in having any contact with appraisers these days. But what the lender can do is come back to the borrower and say, hey, here's what the situation, and discuss with the borrower's agent, you know, it didn't appraise. Probably one of the key things on the front end you can do, as Steve mentioned earlier, a lot of agents will provide comps, have them sitting at the house or even meet the appraiser at the house when the appraiser comes. There's no problem with that, okay? Providing comps that, you know, here's some comps I think you can use. Now, the appraiser may or may not agree. They have to use the more recent comps that are available as close in location and age to your subject property as possible, and obviously as similar to the property as possible. But doing that up front, providing comps and providing maybe a list of here are improvements or repairs that a homeowner has made to the property in the past couple of years, all that information can be helpful to the appraiser up front to hopefully prevent a property from not appraising out. But if it doesn't appraise out, ultimately the buyer and seller can go back and forth and possibly renegotiate and lower that price if we've already tried to provide additional comps or additional information about repairs or improvements that have been made to that property. And I know I've said repairs a couple of times now. Oftentimes repairs that have been made to a property just to keep that property in the condition that it should be in to be marketable, don't necessarily affect the value as much as what a homeowner would hope, because maintenance of a property is to keep the property in a condition that it should be in.
Right. Yeah, I mean, the lender would tell you if there's a process to reconsider that with additional information. That's going to be lender specific. It is done and available in many cases.
The next question here is there a time frame within which you can have money and where you would not have to source it out? That's a dangerous question. Ethically as a lender, any information that we know, we know. We can't, here's a popular line from an underwriter. I can't unsee something, okay? Yeah. I can't unknow something. So, I think to be careful here and to give you the most appropriate answer to this question, I would tell you this. As a lender, we are typically asking borrowers for bank statements going back 2, possibly 3, in some cases, months. If a borrower has funds in their account for 2 or 3 months, when they come to see their lender, in most cases there's probably not going to be much questioning. But everything has to make sense. Back to that, government involvement in the suspicious activity reports that lenders have to do nowadays. Okay? If a borrower has an amount of assets, particularly recent, that are inconsistent with their income level, there may be some questions. We are required to ask. I don't know if I can answer that question any better.
Well, it comes up a lot. I mean, how far back do you go? Because there may have been some things that they couldn't explain. But as Dan said, it's 2 to 3 months as far as statements. But remember, those statements are done and generated after the month is over, not to date in most cases. So you're looking at potentially going back 4 months because, we're in April now. So if you go back 3 months, we would need January, February, March, some cases. Most of the time it's 60 days. Sometimes statements are quarterly, especially the investments, for example, in 401ks and IRA. So, it could go back beyond the 3 months based on the timing of when the month is and when the statement was generated. So, hopefully that helps.
And we touched earlier on how challenging these addressing deposits on statements can be. At this point, we haven't had another question in the last couple of seconds here. If you have one, please feel free to type it in now. What you see on your screen now, the roadmap to closing document that the committee, as Steve said, has been working on for a while to put together to address some concerns. Annette will be sending this out to people who registered for this webinar today. The PowerPoint presentation is available, as is the document.
I think she's going to send out just the roadmap to closing at this point, but okay. If you wanted the presentation, she can send that to you as well. But you automatically will get the roadmap to closing as you see it on your screen from Annette.
And we are recording this session and have recorded some of the previous sessions, and we're trying to record all of them going forward. And I think the committee is still working on exactly where those recordings will be made available.
Right. Somewhere at the board website.